time for the tech sector. Masai has now placed more than 3,000 students in about 1,000 companies in India and is targeting a revenue growth of 150 crore rupees in FY24, as well as an expansion in headcount. Joining me now is the co-founder and CEO of the company, Prateek Shukla, to talk to us about Masai and its roadmap ahead for growth. Prateek, thank you very much for your time here. Let me specifically come to you about this revenue increase that you projected in the next 3 years. What is going to drive this kind of growth? Because as I was saying, jobs, yes, hard, EdTech sector, even worse impacted. It's not just the macro headwinds. One of the largest names in the EdTech sector recently we saw, getting a lot of negative limelight, and that does tend to have an impact on investor sentiment. How are you targeting this kind of growth in this environment?
Thanks, Ritu, for inviting me, first of all. To answer your question, so one thing which we need to basically separate out is job tech versus edtech. So edtech, we have seen a lot of challenges, but when it comes to job tech, I think the need for the skilled workforce in our country is going to increase manifold in the upcoming years. That's first. Second important thing is we truly believe that this era is going to, or this decade actually is going to belong to tech and tech-related domains. And that's why Masai core focus is on tech. So we believe that there's a huge demand. And to give you a perspective, we have currently 9.5 lakh students fresh out of college gets into IT sector in the country, which is growing. So 2 years back, that number was somewhere around 7.5 lakhs. So that is growing rapidly. And when it comes to the kind of revenue growth that we are projecting, it is still very conservative. We can definitely basically grow beyond this.
Conservative growth, a 3x growth is conservative, Prateek. Well, we hope that does come true. But, tell us what the current run rate is. Where are you at? You're targeting, what, 150 crores in FY24? And this is on the back of what kind of growth that you've seen in the last couple of years, especially post-pandemic?
Got it. So, Ritu, basically, in our case, our program duration is 8.5 months. Okay. So as you know that we don't charge any upfront fees from our students. Student once enter into a program, once they graduate and start earning about 5 lakhs per annum, then only they pay us fees. Okay. So all the growth that we are seeing in this particular financial year is the hard work that our team does in the last year. Okay, so all the students, those who were enrolled in Masai school from July till now, is going to basically graduate in this financial year, and that is something which is going to translate into the revenues that we are talking about. We did close to 2,200 placements last year, and we are going to double down on that to 4,500 placements in this year. So that's one way of basically how the revenue is going to basically come in. And second is we have recently started a program which is meant for second year and third year college students while they are studying in college, so that by the time they graduate, they also start they also have a job in hand. So combining both these programs, we believe that 150 crores is something which our team is quite confident that we are going to achieve it.
But Prateek, tell us a bit about your revenue model. You just told us that, students don't have to pay an upfront fee. It's only after they get a job of a minimum 5 lakhs per annum that you start charging them. So, what is the revenue? Is it largely from, the people you're tying up for hiring, or, where do you earn your money?
So the student have to pay the fees once they start earning money. Once they get to a job, then only we recognize the revenue. So what we do is we work with NBFCs, those who basically underwrites this entire pay after placement agreement. And NBFC basically give us the money upfront, and then they collect the money from students over a period of 36 months. The fees of Masai School is 3.5 lakh rupees. So over the period of 36 months from their salary, the student pay the EMI to the NBFC, and we get the money upfront. So that's the revenue model primarily of Masai School.
Got that. You were also talking about expanding what you have and offer newer courses for people in their final years to be able to get a job. What are these specific courses you're looking to add, and what sort of revenue increase will that lead to immediately?
We have recently started Career Accelerator program, which is meant for colleges, students those who are studying in second year or third year. So Masai School primarily, right from the starting, right from the inception, were always focusing on the graduates and people those who are ready to get into jobs. But there is a clear market which is existing, those who wanted to do Masai School course, but they are not ready to get into jobs right away. They want a slightly longer duration program which they can do with their colleges. Understanding from the need of those students, we have conceptualized this program, which is meant for second year and third year college students. And we have recently started this program like in January this year. And since then, we have seen this program in itself is gaining a lot of popularity in colleges. And what we believe is that out of 150 crores revenue that we are targeting this financial year, around one third of it is going to come out from the Career Accelerator program.
Oh,
and is going to be from.
That's quite significant, Prateek. But, give us a sense. So you said about 9,000 students have enrolled into Masai School so far. You've placed only 3,000. Is that the sort of rate, or and how many more students are you adding on a monthly basis? Say by the end of the fiscal, how many students would you have?
Got it. So 9,000 students is the overall number of students, those who are studying in Masai School across different learning tracks. So far, we have been able to graduate roughly around 4,000 students, and we have been able to actually lesser than 4,000 students, and we have been able to place over 3,000 students so far. Our current placement rate is 91%. When it comes to the addition of the students, we are very cautious in terms of the kind of students that we take into Masai School. Although we don't have any eligibility criteria apart from high school completion, but we take students from all kind of backgrounds, and currently we are intaking close to 500 students every month.
Prateek, thank you very much for your time here on CNBC TV18. It was a pleasure speaking with you.
Thank you so much, Ritu, for having me.
Well, moving on, a pandemic-born startup from Mumbai is seeking to take on Zomato and Swiggy in India's food delivery market. From offering a SaaS platform to restaurants during the #OrderDirect movement to now squarely challenging Zomato and Swiggy in their own territory with a discovery app. Akhil Vishwanath finds out how the startup is all set to disrupt the duopoly of Zomato and Swiggy. Take a look.
When a startup comes along claiming that it is challenging Zomato and Swiggy in India's online food delivery market, how is it even possible not to take any notice? Well, Coca-Cola has not only taken notice, but has made an investment in the startup recently. Not too long after Jubilant Foodworks, which runs Domino's in India, picked up a stake. I'm talking about Thrive, and just how is this startup challenging Zomato and Swiggy? Let's find out. When the pandemic struck in 2020, as #Loyalty, the startup in its previous avatar was mostly helping restaurants with a customer management software and loyalty programs. With only 3 months of capital runway left and the lockdown in place, the co-founders were looking for a way to survive before they found the idea for Thrive.
We realized with our conversations with restaurant partners that due to high commissions charged by aggregators and no access to customer data, they had no ownership on their brand, and they had no way to kind of scale up their brands as well. And with the revenue that they were earning out of aggregators, they were not really making too much of money. It was just helping them with operations, but there was not any profitability out of it. So the idea for us with Thrive and the ordering platform was to enable and empower restaurants to scale up their direct ordering business so that they could start accepting orders directly from their customers itself.
Thrive knew restaurants had loyal customers and started helping them build their own microsites by integrating third-party delivery partners. But the kicker was, Thrive charged just 3% commission, at a time when Zomato and Swiggy were charging up to 25 to 30%, which even made the National Restaurants Association of India, NRAI, think of setting up its own food delivery platform. But Thrive did the job. In less than 3 years since the pivot, it has scaled to 14,000 restaurants in more than 80 cities and has processed more than 1 million orders. For FY 23-24, the startup is targeting a GMV of nearly 100 crore rupees.
The first thing we wanted to do was break up the commission structure, because what we're trying to do is actually facilitate a transaction rather than dictate a ownership on the customer data. This customer is actually a customer of the restaurant, not particularly a customer of the discovery platform.
Given the duopoly of Zomato and Swiggy, #OrderDirect is quite the trend. For instance, if we take biryani, which is India's most ordered dish for lunch and dinner, big brands like Biryani Blues and Biryani by Kilo have been aggressively taking the native route to save on commission. But Thrive feels that not all restaurants and cloud kitchens are easily discovered by consumers. So, to solve the problem, Thrive is piloting a consumer-facing discovery app in Mumbai, building on its B2B partnerships with restaurants.
Automatically, when you launch a discovery platform, a lot of people start talking about competition with larger players. However, our aim with this is very different. With the discovery platform, there is a chance for us to change the economic structure over there. About 30 to 35% of the restaurants on our platform, and we expect this to grow, are passing on this price benefit as a 15% or a 20% cheaper option or cheaper prices on the platform as a Thrive promise to consumers.
But can this work is the question. Zomato and Swiggy continue to struggle with poor unit economics, delivery costs being a pain point. However, Thrive believes it is this third cog in the wheel of online food delivery that keeps it lean and nimble, as it doesn't run its own fleet and instead works with third-party logistics players such as Shadowfax, Borzo, Dunzo, and others.
3PL, we work back with other logistics partners, so that's not a cost that we incur. The charges are passed on directly to the consumer. We've really never felt the need, at least up till now, and at least 5 times our scale, to really build in our own fleet and incur those costs. The current players in the ecosystem have done a fantastic job in the past 10 years. And what we think is a positive disruption is this to become a positive sum game for every stakeholder and the entire ecosystem.
Even as the jostling between Zomato and Swiggy continues, there is a slowdown in India's $5 billion food delivery market. Zomato founder Dipinder Goyal has pointed out that there is a surge in dine-out and the boom in travel has hurt order frequency. Another factor is that most of the revenue still comes from the top 8 cities. 5% of the users account for a third of the orders on Zomato. Now, having said that, the long-term opportunity is scrumptious, and as more cities join in, there can be space for more players at the table, even for Thrive. With camera person Prashant Huge and Balbir Singh, this is Akhil Vishwanath for CNBC-TV18.
With that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.